are you viewing the financials here from a fundamental perspective?
Well, from a fundamental perspective, banks and the economy still face sobering times. 10% unemployment or higher, bankrupt companies, bank loan losses going 2 to 3 times higher. So these are tough times. Having said that, when it comes to bank stocks, we are major buyers of bank stocks and think this is a great opportunity because expectations have gotten so low. There's 3 types of recoveries: V-shape, U-shape, and L-shape. And the new news about unemployment really being less bad than expected somewhat takes the L-shaped recovery, which would be a recession with a Japan-like scenario to follow, off the table. And we think banks are priced for an L-shaped recovery. You take the L-shaped recovery off the table, bank stocks should go higher. And what we think is underappreciated about U.S. banks is that they're resilient. This is not 2008. It's 2020. Capital is twice as high. They've gotten out of some of the most risky activities. And remember that banks are 1/3 of the financial market. A lot of the more risky banking activities from before the global financial crisis have gone to many of the non-banks. So more resilient banks, a less bad economy. And by the way, during this period, banks are getting a lot more efficient using digital banking like never before. So if and when we get through this tough crisis recession period, banks will be a little bit more normal in terms of their operations, but those technology benefits are here to stay.
Interesting, Mike. And you talk about the technology that could help the business model going forward. What about, though, the unavoidably low rates that we're going to have? Yes, we're seeing yields back up by about 10 basis points today, but we're going to have lower for much, much longer. How does that square with the business model of the bank in the future?
Well, that's tough. I mean, these are some of the toughest rate environments in modern history when it comes to banking. I mean, banks make money on the spread between loans and deposits. Having said that, we'll use the same 2 words, less bad. And after the unemployment report today, you've seen a higher 10-year yield. So really what's known as a bear steepener. Low rates, but still getting higher once up to the 10-year. And so that's actually, all else equal, less bad or better for banks as you look out, and a little bit less are going to look like Japan. And don't forget that this government stimulus is the highest in history. I mean, it's Congress, it's Treasury, it's the Federal Reserve, all acted quickly and aggressively to mitigate the impact of the pandemic. And as far as those low rates, I mean, the Treasury is going to be issuing $3 trillion of Treasury securities. Yeah. What do you think happens when you have that much supply? The price goes down, which means the yield is likely to still go higher, according to our firm's interest rate strategy department. So it's already gone from around 0.5, 0.6% up to over 0.9%, and likely to go to 1.2% by year end. So again, less bad are the key words. Bank stocks are priced like it's the global financial crisis, whereas the stock market as a whole is not priced that way.
All right, well then expand on that less bad part. I mean, there's certainly some optimism to be had here. I'm looking at the price target increases that you and your team made here, and I noticed that several of those targets are still below some of the year-to-date highs, including on JP Morgan, Citi, PNC, and overall across the board. When you look at the banking as a sector, you're talking about a price-to-book ratio that's still camped out around that 1 level.
Look, these are the most uncertain times in my 3 decades as a bank analyst. So, today after the jobs report, we've now increased our price targets on all of the 17 large banks that we cover. Every single one, we've increased our price target on. Having said that, these are still extremely uncertain times. The ability to forecast, a couple quarters ahead, not to mention 1 quarter, is extremely difficult. So we are building in a margin of safety, and we still assume a deep U recovery. We don't really recover to 2022, so we're being very conservative. Even with that, we see a decent upside. So if the results from this 1 month were to continue, more employees getting recalled back to work, then we might be a little bit too conservative, which means there'd be even more upside. But we think conservatism is a key way to approach an environment like we've never seen before like this.